Meta platforms caught the market completely off guard. Moments after the company released its latest quarterly earnings, investors reacted fast and decisively. They started selling, and this time it had nothing to do with falling revenue, shrinking user numbers, or weakening margins. The trigger was spending, no, and a lot of it. More specifically, Meta's rapidly growing investment in artificial intelligence. During the earnings call, management clearly outlined how much money had already gone into AI, and more importantly, how much more they plan to spend in the coming years. That message alone was enough to rattle the market. The stock dropped sharply, sliding from roughly $750 per share to below $600 in a short period of time. Since that sell-off, Meta's share price has bounced back to some extent. However, the excitement hasn't fully returned. Investors are still cautious, and the main concern remains unchanged. Is Meta moving too aggressively on AI spending? And will those investments eventually deliver meaningful returns? Which leads us to the key question. Where could Meta's stock be by the end of 2026? That's exactly what we're going to break down in this video. I'll walk you through analyst forecasts, outline the assumptions behind the numbers, and then build a scenario analysis to estimate where Meta could realistically trade. Along the way, I'll explain where each figure comes from, so you can decide whether these assumptions feel too bullish, too conservative, or just right. Let's start with the most important figure, earnings per share. Based on current Wall Street estimates, analysts covering Meta expect the company to generate $33.18 in earnings per share for the fiscal year ending December 2027. This projection reflects what analysts believe Meta can earn once its current investments, including AI, begin to fully contribute to profitability. Whether that estimate turns out to be aggressive or cautious will depend on execution, but it provides a solid baseline for our analysis. Next, we look at valuation. As of this recording, Meta is trading at a forward price to earnings ratio of approximately 21.85. What stands out here is that this multiple sites near the lower end of Meta's valuation range for the year. In simple terms, the market is already pricing in skepticism, largely driven by concerns around heavy spending and future margins. Historically, when investor confidence is stronger, Meta has traded at higher valuation multiples. That's why heading into 2026, I believe an expansion in the forward PE multiple is more likely than not. With earnings and valuation in place, we can now move into the scenario analysis. For consistency, I'm keeping the 2027 earnings per share estimate fixed at $33.18. The key variable we'll adjust is the forward PE multiple, since that's where shifts in investor sentiment tend to show up most clearly. Let's begin with the most conservative case. If Meta meets its earnings expectations, but the forward PE multiple stays flat at around 21.85, the stock could still climb to approximately $725 per share. Even without any improvement in market sentiment, earnings growth alone could support a meaningful move higher from current levels. Now let's consider a slightly more optimistic and arguably more realistic outcome. If the forward PE multiple expands to 24, which is still well within historical norms, Meta's share price could rise to about 796. If confidence continues to build and the multiple increases to 28, the stock could reach roughly $929 per share. In the most optimistic scenario I looked at, the forward PE multiple rises to 32. That would suggest very strong belief in Meta's long-term strategy and execution. In that case, the stock could approach $1,062 per share. This is clearly the least likely of the four scenarios, but it remains possible if everything aligns perfectly. Across all four scenarios, the common theme is clear. Each one points to Meta stock being higher in 2026 than it is today. That said, risk still exists. There is absolutely a non-zero chance that the stock declines. One of the biggest downside risks is continued growth in AI spending without a corresponding acceleration in revenue. If Meta's leadership keeps increasing spending forecasts while revenue growth fails to materially improve, investor patience could wear thin. Markets typically penalize management teams that prioritize ambition over financial discipline. We've seen this pattern before. The last time Meta rolled out aggressive spending plans, it wasn't for AI, it was for the metaverse. Back then, investors delivered a clear message through the stock price. Over time, management responded by slowing spending, shifting its narrative, and eventually moving the metaverse out of the spotlight. Investors rewarded that adjustment, and the stock rebounded strongly in the years that followed. Markets value leadership teams that listen. On the upside, the picture could change quickly. If Meta begins showing faster revenue growth directly linked to its AI investments, sentiment could turn sharply positive. Once results become visible, spending feels justified, confidence returns, and valuation multiples expand. On top of that, if the broader AI landscape continues to advance, with real breakthroughs, measurable productivity gains, and reduced fears of an AI bubble, that could provide an additional tailwind for Meta's valuation. Right now, 65 analysts are covering Meta stock. Of those, 59 rate the stock as a buy, 6 have hold ratings, and there are no sell ratings. The highest price target for the next 12 months stands at $1,117, while the lowest is $685. The median price target sits at $832.50. Based on my own analysis, combined with analyst expectations, I believe Meta's stock could finish 2026 somewhere between $800 to $830 per share. That represents roughly a 25% upside from the current market price, a meaningful return driven by earnings growth and moderate multiple expansion. If I already owned Meta shares, I'd be comfortable with that outcome. I don't currently hold Meta stock, but it's firmly on my watch list. At today's valuation, I see it as undervalued and personally rated as a buy. I wouldn't be surprised if I open a position in the near future. Now I'd like to hear from you. Do you think this target range is too optimistic, too pessimistic, or right on the mark? Share your thoughts in the comments. I read them all. And finally, thank you for watching. I genuinely appreciate viewers who seek thoughtful, data-driven analysis. There's no shortage of opinions online, but my goal is to focus on research backed by data, education, and real-world experience. For those new to the channel, I hold both a bachelor's and a master's degree in finance and accounting. If you found this analysis helpful, consider subscribing. This is not financial advice. Thanks again for watching and happy investing.